Facebook group, like for our town, or for our area, like we just get between
The subcommittee will come to order. Without objection, the chair is authorized to declare a recess of the subcommittee at any time. Without objection, members of the full committee not on this subcommittee are authorized to participate in today's hearing. This hearing is entitled Better Together, Examining the Unified Proposed Rule to Modernize the Community Reinvestment Act. I now recognize myself for 4 minutes to give an opening statement. In the 1930s, the practice of redlining, or intentionally refusing to extend credit to borrowers in geographic areas based on race or ethnicity, was the official policy of the United States government. People of color were largely excluded from home ownership, small business loans, and other opportunities. In the 1960s and 70s, Congress passed a series of laws aimed at stopping discrimination in the housing and financial system. Among these laws, the Community Reinvestment Act, or CRA, was enacted in 1977 and requires banks to meet the credit needs of their communities, including low and moderate income neighborhoods. The federal banking regulators are tasked with scoring banks on how well they are meeting CRA goals and regulations around this law. But nearly a century later, we still feel the ripples of past policies holding our country back. In research sponsored by the Federal Reserve Bank of Minneapolis, the authors found no progress has been made in reducing income and wealth inequalities between black and white households over the past 70 years. And in testimony before this committee in 2019, journalist Aaron Glantz shared findings from his investigation into modern-day redlining, in which he discovered in 61 metro areas across the country, people of color were more likely to be denied a conventional mortgage than their white counterparts, even when they made the same amount of money, tried to borrow the same amount of money, and wanted to buy in the same neighborhood. In May, the banking regulators issued a joint proposed rulemaking to strengthen and modernize CRA. The last time the CRA was significantly updated was in 1995, and since then, the financial system has changed a great deal. Banks are more digital and have fewer branches. Algorithms and automation play a significant role in determining credit risk, and non-bank lenders dominate the mortgage market. The CRA rulemaking is an opportunity to ensure our financial system works for all Americans and to finally put an end to modern-day redlining. A strong CRA rule could be the catalyst we need to close the racial wealth gap. Legislation noticed with today's hearing includes, but is not limited to, H.R. 2768, the American Housing and Economic Mobility Act from Congressman Emanuel Cleaver, a discussion draft entitled the American Community Investment Reform Act, and a discussion draft entitled the Making Communities Stronger Through the Community Reinvestment Act. I look forward to today's discussion and hearing from each of our witnesses about how to best strengthen and modernize the Community Reinvestment Act. I'd now like to recognize the ranking member of the subcommittee, Mr. Luetkemeyer, for 5 minutes for his opening statement.
Thank you, Mr. Chairman. The Community Reinvestment Act was enacted in 1977 to ensure banks are meeting the credit needs of their communities and to combat the practice of redlining where individuals in certain geographic areas were cut off from banking services. However, after nearly 50 years, it is clear the CRA, as it currently stands, is in desperate need of reform. Consumer groups, banks, multiple administrations, and members on both sides of the aisle understand the need to modernize and update the CRA in a meaningful way. The banking landscape has changed since the last major reform of the CRA almost 30 years ago. The rise of mobile banking has upended the traditional CRA assessment area, and a dramatic decrease in branches has resulted in banking deserts. Furthermore, some groups claim the current CRA does not do a good job of driving investment in underserved areas. Other groups say the vague requirements of the CRA do not help banks or consumers understand what qualifies for CRA credit, leaving all involved parties in the dark. It is clear a new CRA is needed that will provide transparency and accountability for the banks. It appears the federal banking agencies attempted to solve some of these issues in their recently proposed rule in CRA. For example, many of the new standards in the rule establish subjective quantitative metrics to determine what activities earn CRA credit and how much each is worth. It is a critical step in modernizing the CRA so banks, localities, and consumers all better understand the program. The proposed rule also expands the importance of banking activities outside the traditional mortgage lending. While mortgage lending remains important, there is an additional emphasis on small business, farm, and automobile lending, along with an expanded range of community service and development activities. I have said many times, it is called the Community Reinvestment Act, not the Housing Reinvestment Act, and banks should be given credit for the myriad of products and services they offer outside of mortgage lending. While the federal banking agencies appropriately tried to solve these issues, I remain very skeptical of this rule as a whole and have serious concerns regarding its direction. According to federal banking agencies, the CRA was established to require banks to meet the credit needs of their communities, including low and moderate income neighborhoods, consistent with safe and sound operations. For nearly 50 years, the CRA has examined the deposit-taking branch locations of banks and determining assessment areas. The proposed rule radically changes that approach by creating retail lending assessment areas, where assessment areas are not determined by deposits, but alternately any geographic area where 100 mortgage loans or 250 small business loans were made. This is a dramatic shift that would place assessment areas on financial institutions well outside of their communities. As I've stated before, modernization of CRA is critical given the rise of mobile and online banking, but establishing assessment areas based on lending metrics is misguided at best. The core idea behind the CRA is that banks must serve the credit needs of the communities in which they are receiving deposits. The proposed rule upends that core tenet. In addition, while the proposed rule does provide subjective quantitative metrics for certain CRA credit, the amount of data banks are forced to compile under the proposed rule is truly immense. According to the estimates within the proposed rule conducted by the FDIC, the total estimated annual burden of this rule will be 225,000 hours. That is a staggering number that will place a significant burden on financial institutions and have an impact on access to credit for the very communities the CRA is attempting to help. This enormous burden ultimately means it will be more difficult for financial institutions to receive outstanding or satisfactory grades on their CRA exams. As probably the only member of Congress who's actually filled out one of these forms, I can tell you this is an extremely big burden for folks, and the present form is very difficult to fill out the way it is. To add more of a burden is just unconscionable. This leads me to my final point. The CRA was intended to ensure financial institutions are serving the credit needs of their communities. It was not intended as a way to hold banks hostage and extort money from them whenever a merger takes place. The final rule produced by the banking agencies should reflect the original intent of the CRA and look to provide access and drive investment into low and moderate income communities. If this rule does not accomplish this goal, then it has significantly deviated from the original intent of the CRA and should not go forward. With the comment period closing on August 5th, I look forward to examining the comments and concerns from industry stakeholders, many of which are still combing through the extensive 679-page rule. I'm also disappointed that a request to extend the 90-day comment period was flatly denied by the federal banking agencies. A rule as important as CRA should not be done in a fly-by-night manner and should have thoughtful, comprehensive input from industry stakeholders before going forward. Look forward to examining the proposed rule with the witnesses today. And with that, Mr. Chairman, I yield back the balance of my time.
Gentleman yields back. Chair now recognizes the chairwoman of the full committee, the gentlewoman from California, Ms. Waters, for 1 minute.
Thank you, Chair Perlmutter, for holding this hearing on the regulatory proposal to update Community Reinvestment Act rules. Under my leadership, committee Democrats shut down the Trump administration's efforts to undermine the law's original intent. So I'm very pleased to see the agencies work together on a new proposal to ensure that banks are meaningfully investing in all communities, not just some. Although the CRA was enacted to eliminate redlining disparities for people of color persists today. For example, the black-white home ownership gap is at a 120-year high, and the mega banks are reportedly denying black homeowners the opportunity to refinance their mortgages at significantly higher rates than white borrowers. So I look forward to the hearing, and I'm hoping that our witnesses can help shed some light on what is going on. I yield back the balance of my time.
Genao-Lady yields back. I am now pleased to welcome each of our witnesses and want to introduce our panel, some of whom are here in person and others are on the platform, so thank you all. Ms. Seema Agnani is the Executive Director of the National Coalition for Asian Pacific American Community Development. Ms. Agnani has more than 25 years of experience in community development, capacity building, and immigrant rights, and was previously a member of the Consumer Financial Protection Bureau's Community Advisory Board. Ms. Catherine Crosby is the chairperson of the National Community Reinvestment Coalition. Ms. Crosby is currently the town manager for Apex, North Carolina, and has played an important role in negotiating bank public benefit agreements with community, regional, and national banks. Mr. Quentin Leighty is the Chief Financial Officer and President of the First National Bank of Los Animas, Colorado. And testifying today, and we're glad to have a Coloradan on this panel, thank you, sir, and testifying today on behalf of the Independent Community Bankers of America. Mr. Leighty has been with the First National Bank since 2005 and is an alumni advisory board member at the Graduate School of Banking, Colorado. Dr. Darrell E. Getter is a specialist in financial economics at the Congressional Research Service. Dr. Getter has also served as visiting economist at the Consumer Financial Protection Bureau and as financial economist at the Department of Housing and Urban Development. Mr. Meeks is walking in right now, and I know he would like to introduce Mrs. Yoselin Genao-Estrella, so I'm going to give him that opportunity before he catches his breath.
Mr. Chairman, you're absolutely right. I ran over here for this opportunity because I'm so pleased to introduce Rosalind, who is the Executive Director of the Neighborhood Housing Services of Queens and provides an excellent and critical resources to the constituents of Queens back in my district. We've been working very closely with our office. They've testified at local hearings that we've had, and the job that they do to make sure that those that are less fortunate than others but have housing is just absolutely tremendous. And so I wanted to run over here to introduce her and to say thank you for all the work that you do in the city and particularly in the borough of Queens.
Thank you, Mr. Meeks. And also, I'd like to thank Ms. Genao-Estrella. She was in a car accident yesterday, I think, and is so intrepid she still wanted to testify for us today. So thank you very much for being here. Thank you to all of our witnesses. For those of you on the platform, I would ask for older members of this committee like myself, take your time, speak slowly, speak as distinctly as you can so that we can better understand your testimony. So I will start with Ms. Seema Agnani, if you would provide us 5 minutes of your testimony.
Thank you, Chairwoman Waters, Chairman Perlmutter, Ranking Member Luetkemeyer, and members of the committee. Thank you for this opportunity to testify on this important joint rule on modernizing CRA. National Capacity is a coalition of about 100 organizations working across the country in low-income Asian American, Pacific Islander, and Native Hawaiian communities. They employ a diverse set of strategies from affordable housing to community organizing and supporting small businesses in order to advance equity and create vibrant, healthy communities. As has been said, I've been working in the community development sector for essentially since the inception of my career. In fact, had read the CRA legislation on my flight to my first job interview in New York City in the early 90s. This landmark legislation was established to address redlining, discrimination, and disinvestment in communities of color. And unfortunately, it's been well documented that income inequality and the wealth gap have continued to widen, as has been said. This is the result, the result of lack of access to safe, affordable financial services, access to credit, and of course, investments in affordable housing and support for micro businesses. Despite this, 98% of banks pass their CRA exams. As has also been said, the Black homeownership rate is really unacceptable, and the overall homeownership rates for families of color in this country are 30 points lower than that of white families. And abusive payday lenders, as well as online lenders, are increasingly concentrated in communities of color and charging unspeakable interest rates, leading to further wealth stripping of our communities. Simultaneously, our communities are being pushed out of neighborhoods that they have long occupied as a result of gentrification and rising rents, as well as predatory investments and lack of access to affordable credit. So the CRA really must be modernized to address the broad range of financial entities that now exist and should be evaluated on the actual and direct benefit to low-income communities of color, as well as disincentivize the types of investments that promote displacement of low and moderate income communities of color. Today, that is the biggest threat to housing stability, displacement due to rising rents and eviction. And the COVID pandemic has only exacerbated that situation. For the Asian American, Native Hawaiian, and Pacific Islander community, the majority of those that are living in poverty are concentrated in the highest cost housing markets, leading to these communities being at disproportionate risk of displacement at this time in history. In addition to this, the limited English proficiency rates that are extremely high among low-income AA and HPI communities puts them at a particular disadvantage in terms of navigating the mortgage process or being able to understand what loan products are being offered to them. This was clearly evidenced through the rollout of the payment protection program in the aftermath of the pandemic, particularly the first round, where our communities were really not able to access those resources that were made available because of the lack of language access, as well as the lack of relationships with mainstream financial institutions. Many of them turned to payday lenders and other alternative lenders due to a lack of access. So we would like to see race and ethnicity centered at the evaluation of CRA evaluations. The current proposed rule really does not go far enough. In addition, we would like to see CRA evaluation being based on ensuring that further displacement does not occur as a result of these investments and lending and loans. In addition, it should further create affordable housing. We would like to see incentivization of preservation of existing affordable housing, naturally occurring affordable housing, and in order to ensure we don't advance homelessness. And unfortunately, the definition of affordability is still too high. The majority of our communities are unable to access those affordable units under the current CRA. Finally, we would like to see language access incentivized in the CRA. It should be, when financial institutions make the effort to reach those with limited English proficiency, they should qualify for CRA credits for things like recruiting employees who speak the languages of the local communities. Thank you for the opportunity to testify today.
Thank you, Ms. Agnani. And I didn't give the witnesses the speech that I was supposed to give at the beginning of your testimony. You get 5 minutes. The screen will show when you're down to 1 minute, and so we try to keep it to 5 minutes and not go too far. I'd like to now recognize Ms. Crosby for her 5 minutes of testimony. I think you're on mute still. I think you came off mute, but we still can't hear you.
Can you hear me now?
Yes.
All right. I am honored to testify before you today on the proposed regulatory reform of the Community Reinvestment Act. I am the board chairperson of the National Community Reinvestment Coalition. NCRC is a coalition of 600 community-based organizations. Our members use CRA on a daily basis to increase lending, investment, and services for our country's underserved communities. I'm also the town manager for Apex, North Carolina, home to approximately 73,000 residents. And prior to that, I served in Dayton and Toledo, Ohio. The notice of proposed rulemaking issued by the federal bank agencies represent the most significant changes to CRA and exams in 27 years. CRA will be more effective in bolstering bank reinvestment activity in underserved communities and ensuring underserved groups' ability to move into high-opportunity communities, the more rigorous CRA exams and ratings are. The NPR proposed some significant improvements in test rigor, but the improvements are not across the board on all aspects of the exams. I am pleased with the Making Communities Stronger through CRA bill circulated by the committee today. The bill would require banks to establish community advisory committees, which would be consultative bodies providing input on bank CRA strategies, plans for meeting the needs of people of color, and on bank mergers and branch plans. In addition, the bill would increase oversight of banks meeting important needs, such as those with small dollar mortgages. Finally, NCRC is pleased we are able to influence the bill's proposal for periodic interagency statistical studies on racial disparities. We are pleased that the American Community Investment Reform Act of 2022 would require CRA exams for security companies and assess their community development financing activities. We do not support the presumption that a financial institution with an outstanding rating satisfied the convenience and needs of communities as part of its merger application. We outline our views about this in recent comments to the FDIC. We strongly support applying CRA to independent mortgage companies as the American Housing and Economic Mobility Act would do. In a previous report, we described how the application of CRA by the state of Massachusetts to mortgage companies is a model for federal law. Persistent racial and ethnic disparities in lending should compel the agencies to incorporate race and ethnicities in CRA exams. An NCRC national level analysis showed continuing disparities in loan denials by race, and when people of color received home loans, their equity accumulation was less. NCRC has asserted in a paper that it is possible for changes to CRA to comply with legal standards if CRA exams lending by race and ethnicity in geographic areas experiencing ongoing discrimination. By including race, CRA could address racial disparities and have direct impact on quality of life and health outcomes. The COVID pandemic disproportionately affected communities of color in terms of unemployment, rates of COVID, and business closures. In part, this is a legacy of 80 years of redlining. NCRC studies have shown that communities of color identified as risky on redlining maps produced by the Homeowners Loan Corporation remain economically depressed and experience a higher incidence of adverse health outcomes. I represent communities that have been distressed for decades due to redlining. The NPR is helpful in that it proposed that CRA exams would assess lending separately in low-income and moderate-income tracts. This will help the distressed and lower-income communities. I also urge that agencies go a step further and to examine lending in underserved neighborhoods with the lowest levels of lending. As documented by NCRC, these tracts are disproportionately communities of color. I was formerly the chief of staff in Toledo, Ohio, which is located in Lucas County. CRA reform is needed there because in that county, low and moderate income neighborhoods are receiving low levels of lending. NCRC documented that from 2018 through 2020 in Lucas County, just 12.4% of home purchase loans were made in LMI neighborhoods, despite 32% of people living there. No lender in Lucas County is doing an adequate job at serving the Hispanic population. Among the top 20 lenders, the percentage of loans to Hispanic applicants varied from 1% to 3%, despite being 7% of the county population. In Wake County, where the town of Apex is located, 20% of the population is African American. Of the top 20 lenders in the county, only 2 make 20% or more of their loans to African Americans. The rest make 8% or less of their loans to African Americans. None are providing loans to the Hispanic community proportionate to their representation. These disparities make a compelling case to examine lending by race on CRA exams in areas experiencing ongoing discrimination. We ask that the agencies reconsider their decision not to do this. Thank you.
Thank you. Right at 5 minutes. Thank you very much. I believe I mispronounced your name the first time. Miss Genao-Estrella. Is that closer? Okay, thank you. You are recognized for 5 minutes.
Good morning, Chair, Member Perlmutter, and distinguished guests, and our own buddy, Congressman Meeks. My name is Yoselin Genao-Estrella, and I'm the Executive Director of the tiny but mighty organization NHS of Queens. Although imperfect, CRA has been a life net for investment in underserved communities. The NPR to modernize CRA represents a step in a positive development, and it's a step in the right direction. However, with the current proposal, CRA will remain far from effective and likely incapable of reaching its goals. Although there's no silver lining to fully address centuries of racial disparity or redlining, a comprehensive cross-sector approach is urgently needed. We appreciate all the three regulators for getting together and putting forth this collective NPR, as well as our legislators in Congress for introducing legislation that could potentially complement the overarching goals of a strengthening CRA. However, we need a bold, holistic approach instead of a piecemeal approach. For CRA to actually address redlining, it needs to consider this goal and strengthen the role of community input, provide access to banking, emphasize homeownership as a path to wealth creation, and explicitly include race. We appreciate the regulators' emphasis on the importance of community input. However, it is not just important to allow community input in this process. Regulators must center the needs and voices of communities of color and LMI people in the exam and ratings. In addition, acknowledging the increase in digital banking and regulating this practice cannot negate the importance of maintaining and opening new banks branches in already underbanked LMI communities and communities of color. Access to banking and affordable, accessible product is critical to building wealth through savings and accessing credit. Yet banks continue to expand and grow their branches, and as branches close and communities are constantly left out of the financial system. We see this phenomenon in our own backyard, where financial institutions create self-fulfilling prophecies by not providing adequate products and services in LMI bank branches, and then justifying branch closures due to the lack of business activity. Immigrant communities, for example, are often left behind of the banking system because of language, culture, and identifications barrier. Homeownership remains an important path to wealth creation and developing an intergenerational wealth for community of color. Yet, too often these communities are locked out of the homeownership opportunities, targeted by predatory products and giving limited opportunities to accumulate wealth due to lower appraisal values. We appreciate the proposed data-driven framework and acknowledge that it could combat great inflation, but we are concerned about the overall impact without significant changes. We are deeply disappointed that the regulators failed to push for regulation that will have CRA live up to the intended purposes to addressing redlining. Despite acknowledging the law's origins and how modern-day redlining persists, all the regulators propose regarding race within the examination framework is to disclose already public data and will have no impact on final rating. As a nation, We are in the crossroads as we strive for racial equality, economic mobility, especially as we recover from the COVID-19. With intentionality, CRA can be one of the engines to end racial disparity and finally combating redlining. The time is now. Thank you for the opportunity to be here, and I am happy to answer questions. Thank you.
Ms. Genao-Estrella, thank you for your testimony. Now I'd like to recognize the Coloradan on the panel, Mr. Leighty, for 5 minutes.
Chairman Perlmutter, Ranking Member Luetkemeyer, and members of the subcommittee, I am Quentin D. Leighty, CFO and President of the First National Bank of Los Animas in Los Animas, Colorado. I testify today on behalf of the Independent Community Bankers of America, where I am Chairman of the Policy Development Committee and member of the Federal Delegate Board. Thank you for the opportunity to testify today. The inclusive, community-focused lending and service required by CRA is the essence of what community banks do. For this reason, CRA has not required us to shift or tailor our banking practices, but only to document what we're already doing. The First National Bank has served the communities of Southeast Colorado since 1901. Today, we are a $580 million bank. Most of our communities we serve are low, moderate, and middle income, and some are designated as either distressed, underserved, or both. I'm proud that my bank has consistently achieved CRA ratings of outstanding. We are an intermediate small bank with 2 assessment areas, and our last examination was in 2020. My written testimony includes a detailed discussion of how we achieved our outstanding score by serving borrowers of different income levels and businesses and farms of different sizes, particularly within the distressed and underserved communities. Our exam also found excellent responsiveness to the community development needs and recognized our donation of funds, employee time, and expertise to critical community development services. Our performance was typical of thousands of community banks. ICBA has developed the following recommendations for CRA modernization. Current thresholds do not reflect the extensive consolidation and growth that has occurred in the industry since 1977. Updated thresholds would partially ease the CRA regulatory burden for most community banks without impairing agency CRA assessments. The agency should create a list of CRA qualifying activities. While the list should not be exhaustive, it would provide banks with greater clarity. CRA regulation should exempt minority and women-owned financial institutions and CDFIs from documentation and full scope examinations. This change would be fully consistent with the spirit of CRA. Finally, ICBA recommends that all institutions that serve consumers be subject to CRA. In the absence of CRA, credit unions are not held accountable for their service to LMI communities. Moreover, the increasing trend of credit union bank acquisitions is removing CRA-covered institutions from the marketplace. We ask that this committee hold a hearing on credit union community bank acquisitions and CRA. As you know, the OCC, FDIC, and Federal Reserve recently released a proposed rule to modernize CRA. I will use this opportunity to make some broad and preliminary observations. On asset thresholds, the proposal would increase the small bank threshold to $600 million and the intermediate small bank threshold to $2 billion, which is short of our recommendation of $2.5 billion. Banks with assets of more than $10 billion would be subject to additional requirements. This would provide welcome regulatory relief for small banks, including mine. The opt-in approach. The proposal would allow small banks to opt in to the new retail lending test or continue to be evaluated under the current test. We strongly support the opt-in approach, as any new test requirement banks to overhaul their compliance management systems and retrain our staff. This disruptive change comes at the expense of community service. We urge the agency to extend the opt-in approach to intermediate small banks as well. The out-of-area activities, the proposal would allow banks to receive CRA credit for beneficial loans and investments made outside their assessment area. ICBA strongly supports this. The list of eligible activities, the proposal requires the agency to maintain a non-exhaustive list of activities eligible for CRA credit. As I have mentioned, ICBA strongly supports this change, which would create more transparency and predictability in CRA evaluations. My written statements provide more detailed analysis of the proposal. Thank you again for convening this hearing today and for the opportunity to hear the community bank perspective. I'm happy to answer any questions you may have.
Mr. Leighty, thank you for your testimony. Now we'd like to recognize Dr. Getter. You are recognized for 5 minutes for your testimony, sir.
Mr. Chairman, Ranking Member, and members of the subcommittee, thank you for the opportunity to testify today. My name is Daryl Getter, and I am a specialist in financial economics at CRS, focusing on financial regulation in the mortgage, consumer, and small business credit markets. At CRS, our role is to provide Congress with objective and nonpartisan research and analysis. Therefore, any arguments presented in my testimony are for the purposes of informing Congress and not to advocate for a particular policy outcome. My testimony begins with a brief background on the Community Reinvestment Act. It then highlights some of the aspects of the proposed CRA rule that was jointly announced on May 5th, 2022 by the OCC, the Federal Reserve Board, and the FDIC. Congress passed the CRA in response to concerns that federally insured banks were not making sufficient credit available in local areas where they were chartered and acquiring deposits. Specifically, the expansion of bank operations across state borders led to concerns that local deposits were being used to fund out-of-state and international lending activities as opposed to housing, agricultural, and small business credit needs at more localized levels. In addition, there was concern about redlining practices in which a bank may refuse to provide financial services to all residents in a local area, perhaps due to discrimination. For this reason, the CRA requires federal bank regulators to evaluate the extent that banks effectively meet the credit needs within their designated geographical areas, including low and moderate income neighborhoods, in a manner that is consistent with prudential safety and soundness regulations. The bank regulators award CRA credits and issue performance ratings, which are subsequently taken under consideration when banks apply for various activities that would require regulatory approval. In 1995, the CRA framework was updated to clarify and standardize the examination process. For example, the concept of an assessment area was introduced primarily with a geographical definition. In other words, a bank's lending activities would be evaluated within the geographical location of its main office, branches, and deposit-taking ATMs, as well as surrounding areas where it may have originated and/or purchased a substantial portion of its loans. The definition of community development was also revised to include the promotion of community welfare, and the definitions of a small business and a small farm were also revised. The CRA examinations were also customized to account for differences in bank sizes and business models. Under the current CRA framework, geographical issues have recently emerged, this time as banks have increasingly adopted technology to conduct digital payments and other online transactions. For the purposes of CRA compliance, a bank may be able to provide electronic and digital financial products to low and moderate income communities outside of its designated geographical assessment area, but whether it receives CRA credit may depend upon an examiner's interpretation of the circumstances. The joint proposed rule that would update the current CRA framework includes the following provisions. The definition of a CRA assessment area would be updated and expanded to allow for evaluating more activities that occur outside of a bank's primary assessment area. Furthermore, the proposed rule clarifies that all activities meeting the expanded community development definition would be eligible for CRA consideration regardless of whether they occur in a designated assessment area. The proposed rule also expands the definition of community development, which is aimed to encourage partnerships with financial entities that promote greater access to financial products and services to traditionally underserved populations and geographies. The proposed rule also incorporates greater use of data and documentation of a bank's lending and investment activities for measuring CRA effectiveness. Over time, these metrics may allow regulators to better gauge average and above average CRA activity levels. Collectively, these updates are intended to promote financial inclusion efforts and they may also result in the evaluation of more community development activities initiated by banks that may not have been evaluated under the current CRA framework. Thank you for your time, and I'm happy to answer any questions.
Dr. Getter, thank you for your testimony. I'll alert the committee and the witnesses. We expect to have votes called on the floor around 11:30. We'll get as many questions in as we can. Hopefully, we can get through everybody who wants to ask questions. But if not, then we will have to recess and then come back to finish things up. So I will recognize myself for 5 minutes for my questions. Ms. Genao-Estrella, one of the new categories of revitalization and stabilization activities in the proposed rule is disaster preparedness and climate resiliency. What types of needs do you see in your community for building more resiliency, and how might directing CRA investment help in those efforts?
Thank you so much for the question, especially since our communities in Queens have experienced different type of disasters. And with right now, as we look to continue being able to provide resiliency, there's not a lot of resources available. Our communities, we cannot continuously depend on disaster relief effort from the government. And we need short-term and long-term solutions. And the climate resiliency, we are very pleased that it's included because it will provide to the very same community that often get the brunt of the disasters that happen constantly due to climate change, by being able to provide investment that are needed in our communities. It is urgently needed. We also are very cautious about being able to provide, include community input in making community plans available and working in tandem with the government as well.
Thank you, and obviously we all know under Hurricane Sandy, communities in New York, outside of New York, got clobbered by that particular event. Mr. Leighty, I've got a question for you. What role do you think banks in Colorado can play in investing in disaster resiliency efforts? And not so much out around Los Animas, but you have brush fires and wildfires out there, and obviously in the foothills and in the mountains, we've had them too. Can you also comment on your bank's experience in disaster recovery?
Sure. Unfortunately, we've had a lot of experience with the fires out in the area, and of course, we're close to the Black Forest fires that occurred here not that long ago, and we got active in helping finance the rebuild of those areas, and we've been very active in helping fire departments, both renovation loans, new equipment, and just being prepared for the growth that's occurred in our state as well. And so we're very active with the municipalities and making sure fire departments have the equipment they need and the financing available to get that. And that's the role that we have played directly.
Thank you.
We also have a couple volunteer firefighters that work for us that leave the job from time to time to go help fight those fires.
Thank you, and thank them for their service. So I've got another question for you. Many bankers have asked for more clarity around what counts as a qualifying activity for CRA credit. Under the proposed rule, the agencies would maintain a publicly available list of activities eligible for CRA credit. Would having such a list of qualifying activities be helpful for community banks in making decisions regarding strategies in reaching low to moderate income communities? And I want this to be answered too by Ms. Agnani and Ms. Crosby as well.
I believe it would be helpful. The more clarity we can have, the more efficient we can be, and the more we can spend time on community development and lending versus wondering what's coming at us on the regulatory side. And so I think it'd be very helpful and something we would certainly use.
Ms. Agnani?
Thank you. Yes, I do believe it would be helpful, although I think a comprehensive list, there will always be additional needs. However, explicitly stating things like language access and ensuring that things like displacement do not occur would definitely reinforce and help strengthen the CRA.
Thank you. Ms. Crosby?
I ditto with both Mr. Leighty and what Ms. Agnani mentioned. I think that also creates greater opportunities for the institutions to work with their community partners to identify opportunities that will help strengthen communities.
Thank you. I have another question for you, Ms. Crosby. Your testimony highlights the need for CRA exams to consider lending to both neighborhoods and individual borrowers by income and race. Can you please explain why this is important and do it in 14 seconds?
That's a little bit unfair, but I'll try. I think it's really important working in two very different communities. One community where lending is not happening at all and there's significant divestment. That's the importance of tracking by place. And then working in a more affluent community where we want to add to the diversity of our community, it's really important to be able to track how people are able to access financial services to be able to live in our community. And that's where you track by individuals. So the importance of mobility as well as the importance of making investments in communities that are underserved is why you need to track by both.
Thank you, and my time has more than expired. I will now recognize the gentleman from Missouri, Mr. Luetkemeyer, for 5 minutes for his questions.
Thank you, Mr. Chairman. Mr. Getter, as someone who's studied the CRA, have assessment areas ever been based on lending activity instead of physical branches or deposits prior to this proposed rule?
As far as I know, the assessment area has been based on lending activity, although deposits is very important.
Right. To me, you look at what the name of this act is. It's the Community Reinvestment Act.
Yes.
You want to take the dollars that are being deposited into the bank and then reinvest those in the community. To me, this is, and to make sure that that money goes back in the community. I think, we have a problem here, and I'm the ranking member on the Small Business Committee, and we set up a small business plan for the restaurateurs of this country. The problem with it was that they highlighted and prioritized women, minorities, and veterans. And that was taken to court and declared to be unconstitutional because it discriminated these three groups over everybody else. And so I'm hesitate to bring this up, but by the same token, I think everybody needs to be aware that when you start prioritizing things like this on race, I think we're going down a rabbit hole here. I think we need to look at this at low and moderate income folks, and I think the way to do this is to say all the money that comes out of a neighborhood needs to go back into it in some way, whether it be in housing or whether it be in small businesses, community projects like churches, community centers, food pantries, things like that. That money needs to go back in there, and there needs to be a threshold on that to make sure that it does. Otherwise, the money gets taken out, and I think this is the argument most people are making this morning. The money is coming out of the community and not going back. So I think if we make the argument that the money needs to go back from the very community that it's being taken from, I think we get to where we need to go, because I'm concerned that if we go down this hole of it has to be only on race, I think we're setting this whole act up to be thrown out of court as unconstitutional based on what I've seen already in the Small Business Committee. Would you agree with that, sir?
Yes, and the statute even requires the regulators to focus on geography. So I don't know if the regulators could even extend by race.
Yeah. Mr. Leighty, you're in the banking business. Would you agree with my assessment there that if we need to have a threshold, make sure all that money goes back into the community to make sure that we protect all the folks who have been depositing with an institution so they can get their community that's what the whole thing is all about. Do you not agree?
I would agree. That's how we reinvest. One of the things that we look at is our loan to deposit ratio, and ours is very high and historically has been because we are reinvesting those dollars back into the community.
As a former examiner, I can tell you that that's something that we always looked at as whether the bank was actually servicing its area by reinvesting in the community in all sorts of ways, whether it be home mortgages, auto loans, small businesses, as well as community service things like churches and food pantries and community centers. To me, this is where this whole bill should be going. The Housing Resource Center, National Housing Conference, put out a paper, Could the Future of CRA Be in Doubt? And one comment in there was, community development, investment, and lending are essential to repairing communities. Yet under the proposal, community development performance would not affect most large banks' overall CRA rating because retail test performance weighs heavier, 60%, than community development performance, 40%. There's a concern that this present proposal has, and this is from the National Housing Conference, which Mr. Chairman, I'd like to offer this as something being entered into the record.
Without objection.
Thank you, sir. Mr. Getter, would you like to comment on that?
No, sir, I decline to comment at this time, I'm sorry.
Okay, Mr. Leighty, would you like to comment on that? That the CRA rating is going to be weighed too far to the retail test performance section rather than the community development preference? Is that a problem with this bill or this proposed rule?
I'm not sure I'm ready to comment on that. I apologize.
Okay. I see I've got 18 seconds left, so with that, I will yield back to the chairman and hopefully get everybody back before the vote. Thank you, Mr. Chairman.
Thank the gentleman. He yields back. The gentleman from New York, Mr. Meeks, who is also the chair of the House Committee on Foreign Affairs, is now recognized for 5 minutes.
Thank you, Mr. Chairman. And just so briefly in response to Mr. Luetkemeyer, the reason why we have to have a CRA is because for over 200 years, this country has focused on race. And the CRA was done as a civil rights bill to correct the historic racism in the United States of America. And I would say that particularly in housing, it still exists today. The injustices and the disparities in housing based upon the history of this country is prevalent and alive, and that's why we need CRA. And we know from the time that CRA was initially enacted, things have changed because banking has changed. And as a result of that, we've got to make sure that we continue to correct the disparities and the racism that this country was built on. And so with that, I wanted to ask Ms. Crosby that we know that relying on data just around LMI communities does not address these racial disparities. And study shows that we need to make sure that it is addressed. So let me just ask you, how do you recommend enhancing CRA so that racial equity is at the forefront of the work that we are doing so that we can get rid of racism and redlining? Ms. Crosby.
So I think that there are a number of examples that this could be done, but we propose an interagency statistical study that would identify metropolitan areas and rural counties experiencing ongoing discrimination. In those areas, CRA exams would include metrics such as percent of loans to African Americans or Hispanics or Asians. And the racial or ethnic subgroups on CRA exams would be based on the results of the statistical study.
Well, thank you for that. And we need to make sure, and let me go through also to Ms. Genao-Estrella, because you talked about, again, in certain LMI communities, in communities of color, banking deserts starting to happen. And so people don't have access to it. So how do you suggest the CRA could address just that issue, the closing of branches in low to moderate income communities and communities of color? How would CRA address those issues?
Thank you so much for the question. Very pertinent to the communities that we serve. We see banking deserts and our community. And one thing that CRA can do is to be able to regulate, and also that there will be a consequence for closing branches that are LMI in community of color, and there will be repercussions because we see when there's branch closures and also when there's a bank desert, what leads when we see it, the repercussion on our small businesses. We see the repercussions that it happened, and there's a correlation between branches and also in bank, and also being able to have economic opportunities and access to banking to those communities that need it the most.
Thank you for that. And I want to also try to get to Mr. Leighty that, you know, I've been supportive of innovation in the fintech space because I believe that they have ability to provide significant access to communities that have historically been shut out of the financial system. But fintechs and non-banks that may not have charters are not FDI insured, but they do provide core financial tools to their consumers. However, the CRA only applies to FDIC-insured banks. So these non-banks and fintechs, which I at times applaud for making underbanked and LMI communities a priority, are outside the scope of the CRA. So, what do you think the role of the CRA should be as it relates to these non-banks? And how do you think CRA regulation of the non-banks could be beneficial to curing racial inequalities?
We certainly support a level playing field and also equality in that CRA space because they are providing great services, but we've seen many times when shadow industry comes in and gets into an environment that doesn't have the same regulatory rules, that affects everybody. And so we would support CRA rules for them, credit unions, and other financial services.
My time has expired.
Gentleman's time has expired. Gentleman yields back. The gentleman from Oklahoma, who's also the ranking member on the Science Committee, is now recognized. Mr. Lucas is now recognized for 5 minutes.
Thank you, Mr. Chairman. While the banking community has changed substantially in the last decade, the Community Reinvestment Act has not been meaningfully revised since 1995. And we are certainly in a different world now than we were 27 years ago. And we can all agree that CRA can be updated to better serve low and moderate income communities. Dr. Getter, could you discuss how this proposed rule attempts to provide clarity on whether CRA credit applies to digital financial products and services that benefit an area outside of a CRA assessment area?
Yes, and I've had a moment to also think about the previous question, so I think I can do both of this at the same time. So,
Please.
for the most part, the CRA does provide, the proposed rule does provide more clarity on the specific community development activities. They came up with 11 new categories that will let banks know that these loans will be eligible for CRA consideration. The issue is that that category would only count 30% instead of 45% for the retail lending area. Now, with the retail lending area, they did say you can, if you do a substantial amount of lending in these areas outside of your assessment area, you can create an assessment area and that'll be included. What I would say might be something to think about or an issue to think about is that because the statute says we want you to cover lending in a geographic area, the regulators have to give 45 or higher weight to loans in the retail assessment area, whereas in the community development area, they can include all loans in all areas, but it's given less weight because it's not directly in the assessment area. So the CRA incentivizes lending to LMIs. It just gives heavier weight to loans within those assessment areas and areas in which they're doing a substantial amount of lending.
It's my understanding that this CRA rule will have a one-year implementation period following the publication of the final rule. Mr. Leighty, could you give us your perspective on the evaluation process and compliance changes that would be needed by a bank once this rule goes into effect? Basically, is 1 year sufficient amount of time?
So we always like more time versus less. We've got a lot of us wear a lot of different hats. There's very few of us that are siloed in community banking. And so it does take time to get our arms around, especially legislation that has nearly 700 pages to decipher. And so the extra time would be certainly helpful. I would say a year at minimum. And it would be, it's going to cost us. We're going to need consultants and lawyers and maybe even some software to make sure that we implement those changes correctly. The more time we have, the less expense on those ends we can have because we can digest that internally without needing to go to a third party.
This proposed rule offers a list of example qualifying activities that are eligible for CRA credit, which should help reduce uncertainty around which activities will receive credit. It is important that this rule provide clarity to banks before they commit to potential CRA activities. Dr. Getter, could you discuss how comprehensive this list is and if this list includes a process for banks to seek approval in advance regarding whether an activity is eligible for CRA credit?
The list, from what I could tell, was very comprehensive. Where there was uncertainty was if a bank made a loan outside of the area, if they would get credit for it. And I do think that that is one of the issues with CRA. I mean, it's not just the digital reaching out to people that has improved with the technology, but also the way loans are funded has changed over time. And the CRA sort of has a preference for loans that are funded in portfolio. So if a bank wanted to fund just a piece of a loan or get into a loan participation, let's say with a CDFI that was not in its assessment area, they may get some credit, but not the same amount of credit that they would get unless it's in the assessment area. So that's, I'm sorry.
If the chair will indulge me for 1 second, but do you see a process by which banks could get advanced approval in the rule?
Yeah, I don't, they can have a discussion with the regulator. Normally, they make the loan and then go to the regulator for approval, but I don't believe there's anything that's stopping a bank from going to the regulator first and getting some clarification.
Thank you, Mr. Chairman.
Always indulge my friend from Oklahoma. The gentleman from Georgia, Mr. Scott, who is also the chair of the House Agriculture Committee, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Ladies and gentlemen, race is a serious issue. It's been that way since the very foundation of this country. Those brilliant words by Thomas Jefferson, all men are created equal, endowed with certain unalienable rights, among those life and liberty and justice for all. And this man wrote that when he owned slaves. So the reason I'm saying that is we've got to stop being shy about dealing with race. And the reason I'm saying that is, Ms. Crosby, I want to direct this question to you. Now we have a current framework within our rule, but it bases discrimination only on credit. Now with the new rule, I suppose, and you tell me, we're finally putting it in a category of any racial activity, of any type of discrimination. So, Ms. Crosby, it is my hope that you can shed a little light on whether or not these new requirements that we have will have the effect that is needed. would it have little or no effect on the impact of ratings of a bank, and it would not constitute a lending analysis for the purpose of evaluating redlining risk factors. So first, I want you to tell me if this is true. Are you, as a person, satisfied with the, not the current rule, but this proposed rule? Will it do the job of dealing with racial discrimination head on?
Thank you. I think in CRC, we believe that it can be stronger. The agencies proposed to use Home Orders Disclosure Act data to produce exam tables describing lending and rates, but it's not incorporating those findings into the bank's exam. So in addition to that, it's possible for changes to CRA to meet current legal standards if CRA examined lending by race and ethnicity in geographic areas experiencing ongoing discrimination or exhibiting significant racial disparities in lending. We also propose including analysis of lending in underserved neighborhoods with low levels of lending, which are disproportionately communities of color. The agency should at a minimum bolster fair lending reviews accompanying CRA exams for banks that perform poorly in HMDA data analysis of lending by race. In addition, the agency's proposal to use Section 1071 small business and farm lending data by race and gender on CRA exams when Section 1071 data becomes available. So I think there's an opportunity to strengthen the proposed rules so that race can play a greater role in addressing the needs of underserved communities.
So can you explain why it's important that the rule do go further and include information on a bank's lending data in these underserved areas?
So in short, I will summarize it by saying that when there were both federal policies that encouraged redlining by race that disproportionately impacted communities, and we're seeing that today even through our analysis of health outcomes from COVID. When you correlate the data of communities that were most significantly impacted by COVID with the data of communities that were redlined, you see the direct correlation of the impact of those policies that actually discriminated against communities of color and are still persistent today. And so if there were intentional efforts to discriminate against people of color by putting them in certain communities, there needs to be intentional efforts to correct that.
Thank you, Ms. Crosby.
Gentleman's time has expired. The gentleman yields back. The gentleman from Florida, Mr. Posey, is recognized. Oh, he's on the platform. Mr. Posey, you're recognized for 5 minutes.
Thank you very much, Chairman Perlmutter. Dr. Getter, what do you understand to be the objectives of the Community Reinvestment Act?
I'm sorry, would you please say that again? I'm sorry.
What do you understand to be the objectives of the Community Reinvestment Act?
Oh, okay, thank you. The objective is to make sure that banks are lending where they accept deposits or where they were chartered as stated in the statute. So that's what the banks are usually evaluated on, how well they're reinvesting back in their communities.
Okay. The memorandum for this hearing finds much disappointment with the Community Reinvestment Act in achieving those objectives. What does your study of this act suggest are the sources of the disappointment?
Well, the banks say that they were making loans, but it wasn't getting counted. So they wanted to make sure that they got credit for the CRA lending that they were doing.
Okay. The hearing memo speaks about modern day redlining, and this phrase appears widely in discussions of the Community Reinvestment Act on the internet and in policy circles. Can you describe what the modern day redlining is and how it differs from prior forms of redlining?
Well, previously, redlining may have meant not getting a loan, whereas today, redlining could be higher prices. So the HMDA is really trying to capture both. How much credit is being denied, and is the credit being priced correctly?
Very good, thank you. In your research paper, The Effectiveness of the Community Reinvestment Act, you point out that compliance with the CRA does not require adherence to lending quotas or benchmarks, and that the absence of benchmarks, evaluating the effectiveness of the Community Reinvestment Act is difficult. Could you expand a little bit on that theme for me?
Right. The regulators are careful. They don't want to say how much lending is enough. I mean, ultimately, the regulators are also the prudential regulators of the banks. So they don't want to say you got to make this loan, this many loans, and then if the loans don't perform, turn around and have to say, well, now you got to hold all of this capital. So the regulators do try to give banks flexibility. And again, they're just simply trying to make sure that the lending is covered in the assessment area, which is what statute requires.
Very good. Do you believe that given our country's emphasis on free market economics and finance, it would be possible or even desirable to remedy the problem by providing benchmarks for the Community Reinvestment Act based on lending quotas and quotas for other services?
Well, I will say that CRA loans are profitable loans. So it's not like the regulation is forcing them to make a loan that's not profitable. So that's why the loan can be eligible for CRA credit. So the banks go out and lend, and then they get their exam and see how many of those loans are eligible for CRA credit. And sometimes it's hard to separate out. Did the bank make the loan because it was profitable, or did they make the loan because they were trying to comply with CRA? Again, the prudential regulators do not want banks to make unprofitable loans. So I would say that they do have choice in making loans, and it's just a matter of doing enough documentation to show that this loan made a difference in the LMI communities.
The composition of lending portfolios and other bank services are subject to trade-offs with other criteria like risk, return, capital requirements. How does the implementation of the Community Reinvestment Act account for these trade-offs in rating banks under the Act?
Well, indirectly, because they have to cover their assessment areas, it may be an inadvertent consequence that they get credit for holding whole loans rather than sharing risks. So in a world now where you can securitize and you can do loan participations and stuff like that, they tend to get less credit, even if they're helping low, moderate income communities outside of their assessment area, because the law states we want to know what you're doing inside your assessment area.
Thank you. My time has expired, Mr. Chairman. Thank you very much.
Thank you, Mr. Posey. The gentleman from Texas, Mr. Green, who's also the chair of the Subcommittee on Oversight and Investigations, is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Chairman, I kindly associate myself with the remarks of Chairs Meeks and Scott. And I contend, Mr. Chairman, that the current CRA legitimizes invidious discrimination. As evidence, in his 2019 testimony before this committee, journalist Aaron Glantz shared a finding from his investigation into modern-day redlining, which included the following. In 61 metro areas across the country, people of color were more likely to be denied conventional mortgages than their white counterparts, even when they made the same amount of money. tried to borrow the same amount of money and wanted to buy in the same neighborhood. He goes on to say, despite these disparities, 99% of national banks received a satisfactory or outstanding grade on their inspections under the Community Reinvestment Act. It legitimizes invidious discrimination. One of the things that we must do would be to establish strong standards with meaningful sanctions. It's not enough to have standards and don't have sanctions that are meaningful. When I was the president of the NAACP, we engaged with a bank that wanted to merge. That was the point where you could get the attention of a bank that was out of compliance. That's not enough. We need stronger standards and we need stronger sanctions. I am currently considering legislation to increase the Fed fund rate on a bank that's out of compliance with the CRA under stronger standards until that bank presents some sort of action plan and begins to implement it such that we will know they are moving toward compliance. We've suffered long enough. We've suffered long enough. The status quo intends to protect the status quo. There is a desire to have a CRA that would allow 99% of the national banks to receive a satisfactory or outstanding grade when they have engaged in invidious discrimination. So again, in his finding, people of color were likely to be denied a conventional mortgage more so than their white counterparts, even when they made the same amount of money, tried to borrow the same amount of money, and wanted to buy in the same neighborhood. That says it all. We've got to make the change. So let me ask the lady that's in the room with us, ma'am, how do you respond to my comments?
This goes to the heart and now the communities that we serve and that I see it vividly. This is not about 40 years ago. We see it our communities not only constantly being denied, but also there's a pattern. For example, in New York City, 22% of the population is Black, but fewer than 5 loans by CRA-regulated banks go to Black borrowers. There's also, we see patterns after patterns. And right now, we go to the intention, but intention just, it needs to be in action. And we see also that—
Permit me to intercede with 31 seconds left. What do you think of my idea to increase the standards, of course, but also to impose sanctions that are much stronger? What are your thoughts on that?
Yes. It's very important that there's repercussions for bank institutions to be able to, if there's a pattern and there's also they're not providing the products and services that the community need, especially communities of color and also LMI communities.
Thank you, Mr. Chairman. I yield back.
Gentleman yields back. The gentleman from Kentucky, Mr. Barr, is recognized for 5 minutes.
Thank you, Chairman Perlmutter, and thanks to our witnesses. You know, one of the pieces of feedback I receive frequently from my constituents in the banking business is that it's difficult to invest in low, moderate income communities when there's lack of clarity in the examination process for CRA. So let me start with Dr. Getter. Do you believe that banks will best serve and invest in communities when they have a clear understanding of expectations from regulators, when it's objective as opposed to subjective in the exams?
Sure, and also with credit histories from the borrowers in those communities. So when income alone is not the only underwriting criteria, credit history is important, and there's also fair housing laws and equal credit opportunity.
Well, just back to the point, it's the lack of clarity is a problem. And to Mr. Leighty's testimony, and I'll just quote directly from his written testimony, community banks experience inconsistencies in the examination process. The inconsistent manner in which loans receive CRA credit occurs between examinations within an agency as well as between agencies. This makes it incredibly difficult for community banks to plan and implement their CRA requirements responsibly. Dr. Getter, do you believe that this interagency proposal addresses that concern sufficiently?
It definitely addresses that concern. Now, again, if a bank wanted to partner, let's say, with a CDFI, they would not get as much credit as if they held that loan on the books.
Well, let me get specific, and I'll ask Mr. Leighty to comment on this too. I think it's great that the interagency proposal adopts former Comptroller Otting's proposal that an investment could receive a binding decision, or proposed investment or proposed loan could receive a binding decision about whether or not that loan or investment would be eligible for CRA credit. I think that provides the certainty that we need. However, on this illustrative list of activities, which I think is a good idea, a safe harbor, one of the problems that one of my constituent banks has brought to my attention, a bank that does a great job with CRA and invests in low and moderate income communities quite a bit, is this issue on revitalization. And what my constituents said to me, and this is the compliance officer, the CRA compliance officer of the bank, was concerned that the revitalization among the 11 categories that was listed in the proposal only counts if it is under a government program. And she said there are a lot of private groups or projects that revitalize areas, especially in rural areas. Most of our current community development activities in the revitalization bucket would no longer count. Do you believe, Dr. Getter and Mr. Leighty, that this is a flaw in this in the proposal?
I would have to review that. I wouldn't call it necessarily a flaw.
Well, Mr. Leighty, what do you think?
I would have to look at the details, but I would say that a lot of the CRA lending we do is direct without government programs.
Right, that's a
we had
problem.
great
I think
example.
I think the proposal should revise that. There should be opportunity for credit even when a government program is not involved. Let me also ask Mr. Leighty a question about an alternative to CRA. You know, rather than breathing new life into an antiquated mechanism like CRA, why not supercharge opportunity zones and incentivize capital formation in underserved areas through tax relief? Tax relief for community bank retained earnings can promote lending to underserved and rural areas, and this tax relief would strengthen community banks' capital and their ability to lend, create a more level playing field in the financial ecosystem, and increase access to capital in underserved areas around the U.S. Mr. Leighty, would providing tax relief for community banks' retained earnings increase access to capital in communities that are traditionally underserved?
Absolutely, it would. If we had more capital to deploy, we want to efficiently deploy that, and so that would certainly help us have more to disperse.
Well, I'm exploring legislation to do just that. I think it's a suitable alternative, or at least a supplement to CRA, and I'm going to be introducing legislation to that effect. Final feedback, and this is, I don't have time to elicit a comment, but one of my constituent bank compliance officers said that the proposal's multiple new tests, subtests, and factors would subject numerous discrete areas of bank operations to evaluation, and the complexity and vast new data collection and reporting requirements would not facilitate the issue of determining whether or not an activity would result in CRA credit. That's why there needs to be a longer implementation period for this, and certainly a longer comment period. This is a highly complex proposal, and we need more time to
Your time is up. Speaking of needing more time, the gentleman's time
Thank you.
has
I yield
expired,
back.
and he yields back. I will now yield to the gentleman from California, Mr. Sherman, who is also chair of the Subcommittee on Investor Protection and Entrepreneurship and Capital Markets, and is now recognized for 5 minutes. Gentleman's recognized.
Thank you. The last questioner put forward the idea that we should cut taxes on banks or certain banks, and I would just say at a time when we have an enormous federal budget deficit, for us to do that, unless the gentleman has some pay-fors, would simply expand that deficit further. Mr. Lefty, the rules that we have now tend to be somewhat vague, and it tends to matter what the particular examiner decides to give you credit for, count against, et cetera. Do the changes that are being proposed eliminate examiner roulette, where what matters is which examiner you get? And do they provide the clarity necessary so that you know what the rules are? And that the rules are published and not just something kind of everybody knows, but they're not in the written rules?
We think it'd be very helpful. That list would just release some of that uncertainty, and then the accountability when we, if we had a channel to get in front of our regulators and say, hey, we're looking at this project, what is your perspective? Would that qualify for CRA? And to have a time period where they've got to respond back would be very helpful for us to march forward. In most cases, we're going to do those loans anyway, but it's helpful from the efficiency standpoint to make sure we're documenting those appropriately and have them as part of our report.
So you're saying that the rules are unclear and you'd like loan by loan advice from your regulatory agencies, because you can't just look at the rules and determine what is and is not going to qualify?
I think there's just some that are in the gray area, and those are the ones that would come into effect that we'd want to have that dialogue and know the time frame when we'd hear back. So it's not, I wouldn't say that's the average loan, but I would say there's certainly circumstances where it'd be good to have that clarity on the front end, especially if we're looking for participant banks to come into the deal as well, so that they could know that they would have a CRA component to that.
And I would just say democracy works better where the rules are published, the rules are clear, rather than things being in a gray area and an individual bank getting an individual nod or ruling on an individual loan. Got another question for you. The new types of qualified activities specifically outlined in the framework are activities that help communities prepare for natural disasters. Given the increased frequency and severity of wildfires in the West, and as the planet warms, those are only going to get worse, do you believe there'll be an increased demand for loans designed to improve resiliency, and do you see banks like yours able to fill that need?
I think we're well positioned to help with the fire mitigation, to help with some of the new equipment that helps them more efficiently fight fires. We've got a lot of our communities are very small, and so we've got volunteer fire departments only in several of our communities, and so we've played a really crucial role in making sure that they have the equipment they need and the financing at a low price, so that they can afford to continue to grow, and that includes the Black Forest area of the Colorado Springs market as well.
Going to squeeze in one more question for Ms. Genao-Estrella. We've seen the number of bank branches decrease, some 13,000 closing between 2008 and 2020, another 4,000 during the pandemic era. And so we see an awful lot of banking taking place by banks that have either no branches or service the vast majority of their customers online. The branches are irrelevant to most of their customers. Does the proposed rule do enough to make sure that these increasingly important online mostly or online only banks are meeting their CRA responsibilities? And I'm particularly concerned that we say, well, you've got a responsibility in the areas in which you lend, but there may be online banks that only lend in well-to-do areas. So how do these rules properly meet that objective?
Well, thank you so much for the questions. We see that in our communities as a problem, and also we also see it being able to have. We really want to be making sure that financial institutions, they have a responsibility, and also in that there's also we see it also different non-bank activities in the communities. And we want to be able to have regulators that increase access to banking and address digital divide on all banking, not just banks over 10 billions. And we want to be able to, sorry.
I'm going to cut you off because the gentleman's time has expired, and would now like to recognize who? Oh, Mr. Williams from Texas is recognized for 5 minutes.
Thank you for that nice introduction.
He's also he's a small business owner.
You're eating into my time.
And he's owned a car dealer for a long time. He coaches the baseball team. I was going to say the softball team.
So,
gentleman from Texas is recognized for 5 minutes.
I reclaim my time. Thank you. So, look, I'll have a short question, but I'm sitting here and I'm thinking, you know, we should be talking about the things that I'm hearing from my people back home in Texas, one of which is out of control inflation, border, interest rates, crime, food. And today, the CPI numbers this morning came in at a year-over-year increase of 9.1%. I'm one of the few on this today and here in the hearing that remembers 1981 when we had runaway inflation heading toward these numbers. Now, this is not simply a transitory problem like the Fed claimed or a high-class problem that the White House once deflected to. This is having a real impact on all Americans, even the ones we're talking about. Main Street America is being affected. And this is eating away at wages for workers, profit margins for businesses, and this is going to force the Federal Reserve to once again hike interest rates to reverse this inflationary cycle. So these actions will make the cost of capital increase, and that will leave small businesses, home owners, home buyers, and anyone who's looking to get a line of credit in worse financial shape than they were. So I think we should be doing everything we can to help people right now with the inflation crisis instead of discussing a proposed rule, for example, that is still being developed as we debate it here today. Because it is still about these issues I'm talking about. It's about inflation. It's about border. It's about crime. It's about food, and we need to be fixing that. So I have just a quick question for you, Mr. Getter. When we talk about this rule, as the chairman said, I'm a business person. I employ people, and you know, costs going up can sometimes hurt service to your customers, can hurt margins, and so forth. So when we talk about this rule, do you think the way it's currently drafted, do you think that would impose a relatively large new cost on banks that, again, could drive up rates to try to offset the heavy cost? What do you think this is going to do to the banks and their daily budgets that they deal with?
Well, the data collection requirements will definitely increase. Now, how that translates into rates, I'm not sure. It depends on the competition or when the borrowers shop. But the data collection requirements will definitely...
So we're going to see a higher cost to do this, which could come back and hurt the consumer. While in my time's left, I'd ask our banker, private sector banker from Colorado, what he thinks.
Yeah, I mean, there's no question that more regulation flows down and costs the consumer, and regulation's important. We're all for it, and we know that this market needs to have regulation, but it does get to a level where it's cost prohibitive, and it kind of contradicts trying to take care of the communities that we serve.
Well, in my industry too, you've had to hire, I'm sure, in many cases more regulators and loan officers, haven't you?
We have enhanced our audit side of things and compliance side for sure.
Well, anytime there's more costs and regulations, it affects the consumer. And in my business, I've even had to hire, my business is built on commissions, the car business, as you've heard. And I've even had to hire compliance officers, and I haven't found a compliance officer yet that'll work on commission. So anyway, Mr. Chairman, I have some time. I'll yield back to you.
Thank the gentleman for yielding back. Chair will recognize Mr. Caston from Illinois, who's also the Vice Chair of the Subcommittee on Investor Protection, and he's recognized for 5 minutes.
Thank you, Mr. Chairman. I'm generally very supportive of the CRA, but it's always struck me as it's got some sort of inherent structural flaws. And Ms. Crosby, I'd like to start with you and just see if you can confirm my judgment and then sort of get to some possible fixes. Let's say that I'm a bank and I've got someone I can provide a $300,000 mortgage to who's in an LMI community. They'd qualify for, the CRA credits. Would I get any CRA credits if I forgave $300,000 of debt to that same individual? Oh, I think you're muted.
Yeah. Yes, you need to do whatever you did.
I'm on my phone and the internet, so I get confused. I apologize about that. You get CRA credit for activity that is in an LMI track, as well as that is made to an LMI individual. So if I understand your question correctly, if there is a loan made in an LMI track, the bank would get credit for that. In terms of loan forgiveness, I will have NCRC staff follow up on that.
Okay, well, let me give another example. Same tract, same individual, I give them a $100,000 student loan. What if I gave that individual a $100,000 scholarship? Would I get any CRA credit for that?
I'm going to defer to NCRC staff, but I believe if that is in an LMI area, the loan would not, or the grant would not get CRA credit.
So
that particular, but I'll have NCRC staff. I have them with me, and they'll follow up with a response to that.
So we could go into the examples. My understanding to both of those is that the answer is no, and I say that because I'm fortunate enough that I do not live in an LMI community. A lot of my neighbors, like myself, were fortunate enough, we made the best life choice we ever could have made. We were born to wealthy parents. And so I didn't come out of college with a lot of student debt. A lot of my neighbors got help getting their first home, and we have built equity. And we use CRA to try to invest in LMI communities by giving debt to people who in some cases are already over indebted. And we don't give them, we're not giving banks the incentive to get them out from under debt traps. We're giving banks an incentives to give them more debt. And I'm not saying we should mandate. I understand how banks make money, but I wonder, Ms. Crosby, if we were to change the CRA so that banks had the option to give people more equity, do you think that would be an effective way to meet the goals of the CRA and make our LMI communities stronger, more fiscally independent? And how might we do that? And Ms. Agnani, I'd love to get your take on this with the 2 minutes we've got left as well. We'll start with Ms. Crosby.
I'm going to actually have NCRC staff follow up with a response on that.
Okay. Ms. Agnani, any thoughts from you?
Well, in terms of loans versus, equity investments, I think it depends on what who the beneficiaries are of those equity investments and whether the affordable housing or investment in small businesses are really reaching low and moderate income communities and communities of color. So I think it would depend on the type of investment and who would ultimately benefit.
Okay, well, I'd welcome, with the time left, anybody else have any thoughts on this? And again, I understand that there's, banks make money by loaning money, and I'm not saying we mandate charity, but it does strike me that the way that the communities that have a lot of wealth in this country are not the ones that have accumulated a lot of debt, they're the ones that have accumulated a lot of equity. And if any of you have thoughts, either in the time here or in follow-up, of how we might put sort of appropriate scoring in the CRA to give banks another tool, I'd welcome your thoughts.
If I may, Congressman, I think a lot of these conversations we're having Really, at the end of the day, it's about quality of the investments and lending versus quality. Quality over quantity. And, this is really why we need better data and to use data sets like HMDA that actually disaggregate and include racial subgroups. Without that ability to really evaluate investments and lending, we won't be able to really solve for these problems.
Thank you, and I yield back.
Gentlemen's time has expired. Votes have been called, but I want to see how many more members we can get through. Mr. Loudermilk from Georgia is recognized for 5 minutes.
Well, thank you, Mr. Chair, and I'll try to be brief. Under the proposed rule for a bank to receive an outstanding rating, its CRA performance would have to be at least 125% of the median. Over the last 3 years of banking activities, not one bank with more than $50 billion of assets would have achieved an outstanding rating, and less than 2% of banking assets are in banks that would currently be considered outstanding. Mr. Getter, my question is, if it's almost impossible for banks to receive an outstanding rating, would that incentivize them to do more or less CRA activity?
It could incentivize them to do less or just maintain the status quo.
Okay, thank you. That's what I think most people would perceive. Because if there's no reason for a bank to invest more resources, if there's a chance of achieving a higher rating, I agree with you. I think it could cause them to do less. Another area is one of the biggest problems that we have with the current CRA regime is that regulators often do not deliver exam results for years back to the banks. Unfortunately, it appears that this rule would only make the problem worse because results will be based on backward-looking peer metric comparisons. So, Mr. Getter, if banks do not find out how they did until years later, doesn't that cause significant delays with getting CRA investments where they're mostly needed?
I don't know if the results would cause delays. I've heard complaints that the results are slow, but again, if there's money to be made, I don't see the bank just walking away from it waiting for a past CRA exam. But you're right, banks have complained about not getting feedback quickly.
Okay. I have one other area of concern, and I've heard about the proposed rule that some of the compliance deadlines, like the first quarter, that is at least 60 days after the final rule, are very short. Mr. Leighty, is that a concern for you, and can you share why that would be a challenge for community banks?
It is a concern. We wear a lot of hats, and we're serving our communities too. We're investing a lot of time out in the community, and anytime we have added regulation, it's just helpful for us to have more time to get our arms around what exactly it means without having to go hire a bunch of service providers to get us there quickly. So with a 700-page change to CRA, there's just going to be a lot of things that we need to make sure we're covering, and so the more time we could have, the better. For sure.
All right, thank you, Mr. Chair. I yield back.
Gentleman has yielded back. Thank you for cutting your questioning a little short. Mr. Foster, who's also the chair of the Task Force on Artificial Intelligence, recognized for 5 minutes. If you can do the same, then we can get to Mr. Rose and maybe to Mr. Garcia.
Yep, well, I will speak rapidly if we can get the lawyers to stop talking. As part of my role as the chair of this committee's AI task force, we have been looking at how AI technology can help improve all aspects of the financial services industry, including achieving equity goals. The Community Reinvestment Act was passed by Congress in 1977 with the explicit goal of responding to redlining and discrimination against communities of color. And still decades later, in part because the law was written in a race-neutral way, a 2018 report by the Center for Investigative Reporting found that redlining effectively persists in 61 cities throughout the country. New technologies, such as artificial intelligence and machine learning, have the ability to automate loan underwriting and can make credit decisions and process thousands of applications at an unprecedented rate. Now, this will lower cost and does lower cost, but can also make credit more available to LMI communities. But it comes with risks. and these risks have been highlighted by our AI task force. So I guess to all of the witnesses here, how can banks utilize artificial intelligence, or are they already utilizing artificial intelligence in a way so that it actually benefits low and medium and moderate income families and people of color in developing and revitalizing their communities instead of just exacerbating it? So is there good news here in relation to AI? Anyone?
It's my understanding that banks are not using the machine learning to make the actual credit decision, because if the regulators ask them, you know, how did you get to this decision, and it's so much data and they don't understand it, then they can't answer that question. So just from my understanding, machine learning may be valuable. They may take in the application or something like that, but the actual credit decision is made so that the bank can explain it.
I can speak from the community bank perspective, but our business model is the opposite. I mean, it may be lacking in efficiency, but very strong in the relationship base. And so we sit down at the table and get to know each other, make sure that we understand the exact needs and custom make products for our customers. And so artificial intelligence certainly has a place, and we're heading that direction, but that is something that we have not spent a lot of time focusing on, given our business model.
Yeah. Now, do you end up using it implicitly just in your advertising and outreach? Just, you know, there's examples of people using Facebook-driven stuff, and whether they plan to or not, they end up using AI for good or ill. And is that, how do you handle that?
No question. We do have some marketing efforts that use the digital platforms, and I'm sure there's a lot of AI going on in that background. That's been less than 12 months for us, so we're new to that space, but certainly heading that direction.
And just to add to the comments, we've heard some AI-driven lenders using the type of college that someone attended as an Ivy League school in their underwriting decisions. So the further the AI strays from variable used in traditional underwriting, the riskier it becomes from a fair lending perspective. Agencies must subject AI to rigorous fair lending reviews to ensure that no racial, ethnic, or gender disparities arise that are not justified by business necessity, which is the standard established by the Equal Credit Opportunity Act.
Yes, and if I can just add, you know, unfortunately, I can follow up with specific research. I believe women of color are disproportionately negatively impacted by machine learning in lending, and so we need to proceed with caution.
Yeah, one of the tough things is when you end up using an algorithm that makes it better for everyone, but some are helped more than others. Is that an acceptable thing or not? And that's one of the things we've been struggling with on the AI issue for a long time.
Yes, I will agree with my fellow panelists and witnesses. Definitely, we have to, because this is something for the future, but also we need right now. There's the communities that we serve. Therefore, there's right now a negative impact, because we need to go back to the basics. And if we have a structural problem, racial disparities, that is very little that is going to, the artificial intelligence, especially when we are not sitting at the table to making those decisions and who will be there. So it's definitely in the right direction, but we need to do more.
Okay,
Thank you.
My time is up and yield back.
Thank you. The physicist's time is up. Mr. Rose from Tennessee is now recognized for 5 minutes.
Thank you, Chairman Perlmutter, another lawyer to talk now. And Ranking Member Luetkemeyer, thank you for holding this hearing, and thank you to our witnesses for being here. I would just like to make a comment at the outset that we need to stop with these gimmicky titles to hearings that foreshadow a specific bias to the subject to be examined. Today's hearing is entitled Better Together, Examining the Unified Proposed Rule to Modernize the Community Reinvestment Act. Is it better together? It might be, but how can we approach the hearing with an eye towards neutrality or objectivity if the very title of the hearing already reflects a certain type of bias and appears to be a jab at former Comptroller Otting? The public has not even had time to weigh in on this issue. Indeed, the comment period is still open, and individuals, financial institutions, and other interested parties are still combing through the rulemaking. They've also asked for an extension of the comment period, which was ultimately denied, a common trend among Biden's financial regulators. Imagine being a financial institution right now, spending hours on the Federal Register trying to figure out how these new rules and regulations will impact your business, and, in many cases, trying to do so within the confines of an abbreviated comment period. Now, as my time is limited, I will dive right into some questions. Mr. Leighty, are you worried about the complexity and length of this 679-page rulemaking, and are you confident that community banks will be able to comply with it?
Ultimately, we'll be able to comply with it because our business model isn't changed because of it. We take care of our communities. Two of the communities we operate in, we're the only bank in town. There wouldn't be a bank without us. And so that's our mission. But yes, a 700-page change will certainly take a lot of time, effort, and a lot of resources to get up to speed with, and a lot of help from the ICBA and others.
Dr. Getter, Mr. Green just stated a few moments ago that he is working on a proposal to raise the federal funds rate on banks that are in non-compliance with the CRA. Mr. Leighty, Dr. Getter, you don't have to comment on what impact this would have, perhaps on individual banks, but what impact do you think this would have on the banking system?
Well, it does increase the cost of funds, especially if they're using deposits to fund their loans. Actually, it may even increase the cost of, I mean, for the entire banking system, it could increase the wholesale funding and the cost to get the funds to make the loan. So that would be an issue.
Well, thank you. I think that would be a terrible idea, frankly, one of not helpful at all. But shifting, Dr. Getter, I would like to discuss the retail lending assessment area test and the inclusion of indirect lending in that test. We usually think of indirect lending as auto dealer lending, but this will also sweep in dealer-initiated lending in the equipment and transportation financing sectors. Banks have very little input on these loans since they are generally acquired through partnerships with dealers, and the banks have almost no control over the geographic distribution or the marketing of these loans to customers. Equipment and transportation finance are unique in that there are fewer dealerships that originate these types of loans. Further, there is an even more unique customer base that isn't comparable to the overall aggregate of small business lenders or demographics. The proposed changes could result in banks leaving markets, creating less opportunities and healthy competition for loans in low and moderate income census tracts or to low and moderate income borrowers or businesses with revenues of $1 million or less. Dr. Getter, if the goal of the CRA is to encourage lending by banks to low and moderate income communities and individuals, why is it logical to include categories of loans where the bank has no say in the communities or individuals they serve?
Well, it's my understanding that they are supposed to do oversight over their indirect lenders. They are supposed to pay attention to that according to what I have heard from various regulators. So, and if banks decide they want out of it, my guess is the non-banks might step in and take up some of that business. So I don't want to speculate. So I'm not 100% sure. All I can say is having the automobile data might shed some light on where some real discrimination may or may not be.
Thank you, Chairman. I yield back.
Gentleman's time has expired. Now I'm trying to figure out who I'm going to next. Mr. Norman or Mr. Tim? So, Mr. Garcia, you're not on the committee, so you're last. You're going to close this out. Mr. Timmons?
Yes, sir.
Mr. Timmons is recognized from South Carolina, is recognized for 5 minutes, and then I think we'll have to take a break and go vote.
Thank you, Mr. Chairman. Thank you, my friend. Appreciate you holding this hearing, and thank you to each of the witnesses for joining us today. I'm going to start. Dr. Getter, part of this new Community Reinvestment Act overhaul is that banks will be evaluated in so-called retail lending assessment areas, which is any location the bank makes 250 or more small business loans or 100 or more mortgage or small farm loans. Is it possible a bank might reconsider and even limit lending in a particular area to avoid meeting what seem to me to be extremely low thresholds in these retail lending assessment areas?
It depends on if it's one of the banks that were complaining that they were not getting enough of their loans evaluated for CRS. So I guess it really depends on the uniqueness of the bank. Some banks are probably glad to have it, and maybe there could be some banks that won't, but it would be captured under the community development test.
So this could be an unintended consequence, and we need to make sure that we're structuring this in a manner that would avoid that if possible. Would you agree with that?
I'm sorry, would you just say that one more time?
This could be an unintended consequence, and we need to make sure that we're doing everything to avoid that outcome. Would you agree with that?
I guess maybe the CD test would pick up on what's not happening. The CD test is supposed to pick up anything that's not necessarily included in the retail lending test, if my understanding is proper. So the regulators will catch it.
Okay, thank you. Dr. Gitter, another question. Can we talk about the data collection aspect of this? As I've started to chat with banks about the proposed rulemaking, one common concern has been the new data collection piece of this. The biggest banks do not really care about this, and the smallest banks are written out, but this is a potentially huge burden for mid-sized banks. Can you explain to us the new compliance burden that would be leveled on banks for data collection?
The automobile loans, and I believe for the banks that are 10,000 and over, that's more of the digital collection thing. They have to respond to that. It's a blessing and a curse. It's a double-edged sword because there's a lot of complaints that banks aren't doing enough lending. So at some point, the data will be needed to either confirm or deny how much lending is being done by the banking system. So it will be costly, but at least we can go off of evidence at some point once we have the data.
Could you talk about what kind of information is required to be submitted, how often, and any guesstimate on cost and time required for it?
Well, the regulators are going to try to harmonize it with HMDA and with Section 1071. So in the CRA examinations, let me just say 3 to 5 years. So my guess is they're just going to have to collect data, constantly and have it ready, because if they're doing mortgages, they're definitely collecting HMDA data every year. And then we'll wait and see what the Section 1071 requires. And then, so data collection is just a new way of life, I suppose, in a world of technology, in digital modernization.
Sure. Which regulators would be in charge of collecting the data and going through it?
Who's going to be in charge? I'm sorry?
Which regulators?
For CRA, it'll be the banking regulators. For the HMDA and the Section 1071 is the CFPB. Yes.
Okay, one final question. Where would this data, which would be pretty sensitive, be stored? So is there any concern with cybersecurity investments, costs associated with that? The compliance cost alone is going to be large because of additional individuals and time that will be required. But do you have any cybersecurity concerns, and is this going to create another layer of sensitivity?
Yes, there's cybersecurity concerns, and I believe that's the reason why the small banks will be able to stay under the regular CRA test, and that's part of the reason why Section 1071 is taking so long, based on my understanding. So we need the data on kind of the smallest institutions served by some of the smallest banks, but because of the data collection requirements and the cybersecurity risk, it's been taking some time. So
All right, the gentleman's time has expired. I'm going
Thank you, Mr. Chairman. I yield back.
Okay. We're going to go to Mr. Garcia. Mr. Garcia is recognized for 5 minutes. I'd ask you we have no time on the clock for voting on the floor. 286 people have yet to vote. If Mr. Norman wants to, we're going to end up reconvening for him. But Mr. Garcia, please go ahead.
Thank you, Chairman Perlmutter and the Ranking Member Luetkemeyer for hosting this important discussion on the Community Reinvestment Act. Very timely hearing. And of course, I want to thank our witnesses who've shared their time and expertise on the Community Reinvestment Act with us. I come from Chicago, and the story of the CRA runs deep through my city and our communities. It was in the Austin neighborhood near my community where a community organizer named Gail Sankata led the fight against discriminatory lending practices and earned the nickname Mother of the CRA. So it's fitting that last year our governor signed Illinois' CRA, making us a second state in the nation with its own protections against redlining and discrimination in lending. That's important to immigrant communities like those that I represent on the northwest and southwest sides of Chicago and suburban Cook County, because the CRA isn't working for us. For every dollar lent into majority white neighborhoods, only 13 cents go to Hispanic neighborhoods like mine. And the investments we do receive fuel gentrification and displacement all too often. So I'm heartened that our federal regulators are taking up the task of modernizing the CRA, because real change in lending practices is a nationwide problem and needs a nationwide solution. Questions for our witnesses. Ms. Agnani, from Gail Sankata's day until now, our communities have been clear about our needs in the face of redlining, discrimination, underinvestment, and displacement. It's clear that our existing financial system wasn't built for us. We need protections. Do you think it's important for the federal regulators to receive community input as they revise CRA? And what should that process look like? And do agencies like CFPB have anything to teach us about how regulators can consult with our communities?
Thank you, Congressman. Yes, absolutely. I also originally come from the Chicago area and have worked in Queens. So most cities that are in focus in this hearing are really critical. Absolutely. I think, focusing in on the displacement issues, our communities need investments in lending that will ensure residents can stay in the cities that they live in and work in and have helped to build. And so CRA credits should be given only if existing residents are able to stay in their cities and the small businesses are allowed to thrive. So that needs to be part of the evaluation of whether CRA investments are effective. Sorry, I'm not sure if I answered the specific question.
That's fine. Thank you so much. And a question for Ms. Crosby. Since the CRA was last revised, new players like non-bank mortgage lenders and fintechs have revolutionized finance. And if our laws don't catch up with them, we risk predatory behavior and possible financial collapse. One issue that I focused on is industrial loan company charters, which not only allow for under-regulated parent companies to own a bank, but raise questions about a bank's responsibilities to its community. What do you think Congress and regulators can do to make sure that a revised CRA adequately covers these new industries?
So IOCs have CRA obligations like traditional banks. NCRC is not supportive of IOCs since the IOC parent company can be non-financial companies. This introduces potential conflicts of interest in which the IOC can be pressured to make unsound loans to its parent or cut off credit to the parent company's competitors. BMW Bank is an example of an ILC that has a CRA exam, but the CRA exam evaluates an inadequate strategic plan, despite being a lender offering billions of automobile loans across the country. BMW Bank created a strategic plan in which it has designated Salt Lake County to be its only assessment area because that is where they are headquartered. The strategic plan does not create goals for automobile lending, but only for community development financing and services. While the community development is important, lending should also be examined and should be examined across the country.
Thank you very much. I see my time is up, so Mr. Chair, I yield back.
Gentleman's time has expired. Mr. Norman may have questions for the panel, but I think I'm going to take the chair's prerogative, and I'd like to thank our witnesses for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional questions, or in Mr. Norman's case, his initial questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you are able. I want to thank you all for your time today and for your testimony today. We appreciate it. And without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I remind members that written questions and materials for the record should be submitted to email address provided to your offices. And again, I want to thank our panelists, and with that, this hearing is adjourned.